So let's discuss on groups or consolidation. And this is something we have already done in your lower levels. So, and the group aspect arises as a result of parent and subsidiary relationship, in which, for example, assuming you have a company A, and then company A decides to acquire another company. And how do you acquire a company? So you acquire through buying of shares. So company A decides to acquire company B more than 50% of its equity ownership to 100%. Let's assume A acquires B 90%. So the company acquiring the other one, this is the parent company or the holding company. The company being acquired, if you acquire more than half of the shares, that's more than 50%, this one becomes a subsidiary. Now, if company A acquires company B 90%, there is that proportion of 10%, which is not controlled by the company. Now, this 10% is what we call the non-controlling interest. Also, company A may decide to acquire another company, let's call it company C. In this case, we acquire between 20% of the shares to 50%. So let's assume 50%. So 50% does not yet qualify to be a subsidiary. This one is an associate or a joint venture. So that one becomes an associate or a joint venture. Another difference between our subsidiary and an associate is that subsidiary, since we are controlling more than half, we have more than half of the shares, that means we can be able to control them. But for an associate or joint venture, in this case, you cannot control them, but you can exercise what we call a significant influence. You can influence them, but you cannot control them. You can only control a subsidiary. So now this relationship is what gives rise to what we call group or the consolidation. So that means a group is made up of parent and the investee, and in this case, the investee are the subsidiary. Then, once you determine the non-controlling interest, and non-controlling interest is only found where you have a subsidiary, how do we measure non-controlling interest? We have two methods which can be used to determine or to calculate NCI. One is the proportionate share of subsidiary net asset, or number two, we can use fair value. But this method will be determined on the method used to compute the goodwill. Good. So now let's look at something we call group structure. And we have three forms of group structure. One is what we call a horizontal structure. Now, horizontal structure happens where one company has more than one subsidiary. So for example, if you have company A acquires company B, acquires company C, acquires company D. So for example, 80%, 90%, 60%. So in this case, all the subsidiary, they have the same parent. That's what we call a horizontal structure. Then number two, we have vertical structure. And for vertical structure, it happens where we have company A, that's the parent company. And the parent company decides to acquire another company, let's call it company B. Let's assume 90%. So that means if you're controlling B 90%, who is B now to A? So that's a subsidiary. And if A controls B 90%, there is an aspect of 10% which is not being controlled. That's the non-controlling interest. Then the subsidiary might decide also to acquire another company. Let's call it C. Assuming now B acquires C 80%. So that means C becomes a subsidiary to this subsidiary. So therefore, C is what we call a subsidiary. So in this case, who will prepare the group account? So in this case, is the parent who will prepare the group account. In this case, B will be exempted from preparing the group account since itself is a subsidiary of another company. So, and how does A now control C? A controls C indirectly through B. And how much is the control? So A controls C 90% of this 80%. So you take 90% of 80% and you'll get 72%. So that means the non-controlling interest in C by A will be 28%. And lastly, we have what we call the mixed structure, also known as this structure. And for this structure, arises as a result of where we have company A, that's the parent company, acquires another company, let's call it B, 80%. So that means B is a subsidiary. Also A may acquire another company, let's call it C, let's assume 30%. Then the subsidiary decides to acquire some share in the parent associate. So A buys shares in C. Let's assume they acquire like 25%, or let's assume 30%. So in that case, A is the parent, B is the subsidiary since we have more than half. What about the fate of C? So C can either be a subsidiary or also can be an associate. In this case, how do you control the determine the proportion? A controls C. So how does A control C? One, A controls C directly, 30%, and also indirectly. Also, A can control C indirectly through B. And how does A control C indirectly through B? You take 80% of 30%. So 80% of 30%, and you'll get 24%. So that means the total control is 54%, which is more than half. That means C becomes a subsidiary. But we may have an aspect where, assuming company A controls company B, let's assume 60%. Then B controls C, 60%. Who is C to A? Yeah, the proportion. So in that case, A controls C, 60% of 60%, which is 36%. So therefore, C is a what? Yeah, C qualifies to be a subsidiary. How is it a subsidiary? And the proportion is not more than 60, it's not more than 50%. A can control B. Can B control C? Can B control C? B can control C. C has more than 50% of the ownership. So therefore, if subsidiary can control the subsidiary, also the parent can control the subsidiary, even if the proportion is not more than 50%. If subsidiary can control the subsidiary, therefore even the parent can control the subsidiary. Good. So now let's discuss something from our notes. So on the first page, I think I've explained everything. What do we mean by consolidation? The last bullet we have is non-controlling interest. Let's go through non-controlling interest. A non-controlling interest is a proportion of net asset in the subsidiary that's not owned by the parent. And AFR 3 allows two alternative methods of determining NCI. One is NCI as the proportionate share. We say that NCI as the proportionate share. And then number two, NCI at fair value. You can measure NCI at fair value. And then I have explained about the group structure. Then there is an NB there. NB, that only subsidiary is consolidated. And for ordinary share capital and the share premium, only for the parent is recognized. So when preparing the group account, the parent is the company which will consolidate the financial statement. We are saying that in this case, we only consolidate a subsidiary. We don't consolidate an associate, since we cannot control the associate. So we'll be accounting for associate using what we call the equity method. So you only consolidate subsidiary, therefore you don't consolidate an associate. Then you see that for ordinary share capital and the share premium, you only take for the parent. That means you don't consolidate ordinary share and the share premium. Good. Then on acquisition, when one company acquires another company, the difference between the purchase consideration and the net asset acquired. So for example, if the company is worth 100 million, you decided to pay it 110 million. So that difference of 10 gives rise to what we call the goodwill. So therefore, this goodwill, on how to determine the goodwill on acquisition. Goodwill on acquisition. And we have two methods you can use to compute goodwill. One is the full goodwill method. And number two, we have the partial goodwill method. And we are saying that goodwill is the difference between the purchase consideration or the cost of investments and net assets acquired. And net asset acquired. So the difference between the two, that's how you get the goodwill. So, and how determine the net asset acquired? So let me elaborate on that. So goodwill, you're saying that to get goodwill, you take the purchase consideration then you raise net assets acquired. And how determine the amount of net asset acquired? So to determine the net value of the net asset acquired, you go to the equity elements. And for the equity element, we have ordinary share capital. We also have share premium. And then you take other reserves, such as retained earnings, evaluation reserves. But for the reserves, you take the pre-acquisition. How much was the reserve at the date of acquisition? So you take pre-acquisition, retained earnings, as well as pre-acquisition reserves, and the reserves. So, and then you get the proportion. So the difference between the purchase consideration and the net asset acquired, that one will give rise to goodwill. And you're saying that we have two methods which is to compute goodwill. One, we have the full goodwill method. And number two, we have partial goodwill method. The difference is that for full goodwill method, in this case, you compute the goodwill of the subsidiary as a whole. That means in that case, you get the goodwill for the parent as well as for the subsidiary. But for partial goodwill, you only consider the parent goodwill in the subsidiary. So what do I mean? Assuming company A acquired company B 80%. A is the one which acquired B 80%. So that means the parent company, B is the subsidiary. Now we want to determine A paid B 110 million, but the net asset or B at the date of acquisition, it was only worth 100 million. So when using the full goodwill method, full goodwill, you take the purchase consideration, which is 110 million, you raise the net asset acquired 100. And in that case, you get full goodwill, of which is an amount of 10. Now that's what we call the full goodwill. In that case, you don't take into consideration the proportion. You compute the goodwill of the subsidiary as a whole. That means in this goodwill, we have both the parent goodwill in subsidiary, and then we have the non-controlling interest goodwill. But for partial goodwill method, you'll take the purchase consideration, which is 110, minus the net asset acquired. The net asset acquired was 100, but of this 100, we only acquired a proportion of 80%. So you take 80% of the net asset, and the difference between the two, that's how you get the partial goodwill. And the goodwill should be recognized as part of the non-current assets, and therefore should be assessed for impairment at each and end or at each end of the financial period. Good. So now let's still discuss that. So still on page 1, we have the preparation of consolidated financial statement. Yeah, at the end of each financial period, if the company has acquired or they're in the group structure, they need to prepare the consolidated or consolidated financial statement. So the parent company prepares consolidated financial statement using uniform accounting policies. However, the parent need not prepare consolidated financial statement due to the following. So what are some of the exemptions where the parent company is exempted from preparing the group account? In that case, we have very major perspective. The circumstances under which the company is exempted from preparing the group account. Number one, where the company itself is a subsidiary of another company. So for example, if you have a vertical structure, A had acquired B, B had acquired C. This one is 90%, this one is 80%. So in this case, C, its parent is B. So that means B is the parent to C. But B itself is a subsidiary of another company. So in this case, B will be exempted from preparing the group account. So you're saying that, number one, the company will be exempted from preparing the group account if itself is a subsidiary of another company. Then number two, when the company equity or the debt are not listed in the foreign or public market. So in short, that means when it's a private company. So a private company may be exempted from preparing the group account. And then number three, when the company is an investment entity. Investment entity, such as Britam. So Britam, what happens? It provides capital, or you can say Centum. Let's work with Centum. So Centum has more than 150 companies invested in it. They provide capital to a magnitude of more than 50%. If you're able to provide capital more than 50%, that means you own that company. So in that case, assuming the company has more than 150, can you be able to manage to consolidate all the financial statement that you take the sales of 150 company? So in that case, the company will be exempted. In perspective that it's an investment entity, that is day-to-day operation. It's provide capital for other entities, and through the capital, that's how we acquire the ownership. So those are the three major circumstances where the company is exempted from preparing the group account. So number one, so we're looking at the exemption from preparing consolidated financial statement. Number one is where the parent itself is a wholly owned subsidiary or partially owned subsidiary of another entity, of which the other entity prepares the group account. Number two, if its debt or equity instrument is not traded in the local or foreign public market. And then number three, if it's an investment entity such as Britam, Seton, and Centum. Then number four, number five, they are not that major. Then we have goodwill on acquisition. I think I've discussed about the goodwill. And we have the method of computing goodwill. So number one, we have the full goodwill method. So under the full goodwill method, this is where the goodwill of the subsidiary is determined as a whole. And the goodwill comprises the parent and NCI goodwill. Then under this method, NCI is measured at fair value. Can you underline that? Underline that. Then number two, we have the partial goodwill method. Partial goodwill method. So for partial goodwill method, this is where only the parent goodwill is recognized. And in this case, NCI is measured at their proportionate share of fair value of the subsidiary net asset. Good. So now let's look at investment in associate. That's under IAS 28. So how do we account for associate or joint venture? So how we account for associate or joint venture are the same. And we account for them, we say that you don't consolidate associate or joint venture. You account for them using equity method. So accounting for associates and joint venture. So what's an associate? So an associate is an entity over which the investor has a significant influence. Remember, we said that you can control a subsidiary, but you cannot control an associate. So for associate, you account for it using the equity, for the equity method, and you can only have what we call a significant influence. You cannot control them. So what do we mean by the significant influence? So significant influence is the power to participate in the financial and operating policy decision of the investee. And where an entity holds 20 to 50% of the voting power, that's the equity, directly or indirectly, it will be presumed to have a significant influence. If the voting power is less than 20%, it will be presumed to have no significant influence. Therefore, it should be a normal investment. If you invest less than 20%, that one becomes, it's not an associate, it's just a normal investment. You can call it available for sale. Then the existence of significant influence may be by an entity is usually evidenced in one of the following ways. One, representation in the board of directors. of the investee. Number 2 is participation in the policy-making process, including the dividend policy. Number C, when you have material transaction between the entity and the investee. And number D, interchange of managerial personnel, and then provision of essential technical information. So how do you account for associate? Accounting for associate. IAS 28, that's revised IAS, requires associate company to be accounted for using the equity method. So how do we account using the equity method? So equity method of accounting. This is how we account using the equity method. You take the purchase consideration, then you add post-acquisition changes in net asset. Post-acquisition changes in net asset. So when we talk about the net asset, in this case, we compare things to do with the ordinary share capital, share premium, retained earnings, and reserves. But mostly what changes is the retained earnings. So for example, assuming company A acquired company B, which is an associate, 40%. And at the date of acquisition, the retained earnings, what we call the pre-acquisition retained earnings, was 400. But as per the reporting date, the retained earnings has increased to 500. So that means in this case, when factoring in the post-acquisition changes in net asset, you take the retained earnings, you take 40% of the post-acquisition changes. So at the reporting date is 500. At the date of acquisition, that pre-acquisition was 400. So that means since the acquisition, the retained earnings has changed by 100. So you take 100 times 40%, of which you get 40. And then you deduct impairment loss. Impairment loss. So what you get here is what you take to the balance sheet as investment in associate. And this one should be recognized and a part of non-current assets. That's what we call the equity method. We say that you don't consolidate associate, you'll be accounting for it using the equity method. And this is how you account using the the equity method. Good. So equity method is a method of accounting whereby the investment is initially recognized at cost. That's why you take the purchase consideration or the investment cost. And adjusted thereafter for the post-acquisition changes in the net assets. Then you have some exemption of using the equity method. An entity shall be exempted from using the equity method if it meets the following. 1, it's exempted from preparing the consolidated financial statement. And number 2, the investment is in associate is classified as held for sale. Then we have discontinuing of using equity method. When the company discontinue from using equity method? Here you have 2 major points. 1, it's when, for example, if you're controlling 40%, you decide to add another 20%. So that means you get 60%. When the associate becomes a subsidiary, you cease from using the equity method. Also, if you're controlling 40% and then you decide to dispose some of the proportion, that means the control ceases from 40 to below 20%. So in that case also, to lender that you not use the equity method. So discontinuing the equity method. The use of equity method should cease. Number 1, from the date the significance, influence, or joint control ceases. Then number 2, if the investment now becomes a subsidiary. Also, if the retained interest in the financial asset, that's the interest, is less than 20%. Then we have the joint venture. And a joint venture recognizes its interest in joint venture as an investment and shall be accounted using the equity method. Yeah. How we account for joint venture and associate, they are the same. Then we have what we call the joint arrangement. That's under IFRS 11. And what are joint arrangement? This is an arrangement of which 2 or more parties have joint control. And joint control is the contractual agreement of sharing control. And we have various types of joint arrangement. Number 1, we have the joint operations, and then we have joint ventures. So what's the difference? Now, for joint operation, you'll be having the joint control. You'll be having the right to the assets and obligation to the liabilities. That's under joint operation. Then number 2, we have joint ventures. For joint venture, you have the right and obligation for the net asset. That's the difference between the two. So first of all, let's go through the first one, joint operation. And this is an arrangement whereby the parties have joint control, have right to the assets and obligation for the liabilities. Right for the assets, obligation for the liabilities. And then we have joint ventures. And these are joint arrangement whereby the parties have joint control, have right to the net assets. So in this case, for joint venture, you have control
with one of your pen.
assets. And then we have various forms of joint ventures. So open this question.
Yes. Thank you.
November 2020. November 2020. Question 4A. November 2020, question 4A. So part A, you are told that distinguish between the two types of joint arrangement